it wouldn't be fintech without getting a challenger bank in. So I've gone to Klar to see what they can do to improve customer experience in financial services and ultimately improve that financial inclusion here in Mexico.
It has its opportunities to improve. About 40% of people still don't have access to a basic bank account. About 85% of people don't have access to a credit card. So judging by those two indicators, I think there's a lot of opportunities to improve, right? I think on the debit side or the current account side, where we have 40% of people that don't have access to a bank account, it's by no means excusable. No, even for emerging economies, we've seen efforts that have made that gap disappear, over the last couple of years, and with technology, there are no excuses. And on the credit side, even compared to economies such as Brazil, where about twice as many people, or almost 2.5 times as many people, have access to a credit card with a very similar GDP per capita, there's little excuse on that side as well. I think part of it has been driven by the inefficiency or the complacency of the incumbents, right? Where the reality is that the incumbents have managed to find niches in which they can derive a lot of profit from, and they've made that has made them quite complacent, right? And there's also inefficiencies mainly on the credit side, where underwriting becomes expensive, where there's not enough data in order to serve the markets that are underserved. So I think it's because of the complacency and the inefficiencies that exist within the sector that the state of finance is quite improvable, let's call it.
Why is it, do you think, that the banks, the traditional institutions, have maintained that complacency over the last couple of years? And why do you think Klar and some other fintechs are in the perfect position to take advantage of that complacency?
I think there's three elements, right? One of them being the cost base with which they operate, right? The average of the big guys has about 1,500 branches, about 40,000 employees to serve the retail segment. And very blown up overhead structures with very big expensive buildings that I'm sure you've noticed along the more expensive streets in town. So one of them is pretty basic, but it's the cost structure that they've built up over time. Given that it was a protected market and everyone was doing the same, they just built up very expensive fixed cost bases. The second one being technology. Right? I think technology, that ties a little bit into the first, but their systems were built 30, 40 years ago, and not to blame them, right? That's the way it was, and everything is a big monolith in a way or the other, right? So it's pretty difficult for them to truly take distance from that. So those are the two things that mainly drive the high cost base that makes them focus on a segment that can allow them to break even at a fairly early point in the lifetime of the user, right? Where they say, this is how much it will cost me to serve them with this infrastructure that I pay for. Thus, I cannot access segments that are not profitable for me, or where the ROI is not interesting to me. And then the other one, I think it's a bit more conceptual or cultural, but it could be about the importance that they've given the user, right? Where it's not necessarily the most important metric in their board meetings, right? Where nobody talks about NPS, nobody talks about customer centricity, nobody truly is close to the user, trying to understand what type of services could truly be of value. So I think those three elements have kind of derived in a cocktail that lets them with the segment they're already serving, which is a higher end segment in which they can break even quickly, and with products that are also a bit old-fashioned, if you want to call it that, where they're not standing close by to the user, trying to understand what is truly of value to them.